Hello everyone. Hello everyone. I hope you guys. Hello everyone. I hope you guys can hear me. All right. So we are going to start with the concept of risk and uncertainty today. Risk and uncertainty. It's a really very important concept in terms of decision making. Let's try to have an idea about what is the concept of risk and what is the concept of uncertainty. See, risk actually means that there is chances. I mean, future is unpredictable, but we can estimate few probabilities. For instance, we can say that there are 40% chance that situation A will occur of situation A, and there are 60% chances that situation B will occur, right? So if we can connect, if we can identify probabilities with respect to the scenario, then that comes under the heading of risk, under the heading of risk concept, right? And usually we consider the concept of expected value in that case, right? And if we cannot estimate that what will be the probability of the situation to occur, and are you there? Can you hear me? Hello, can you hear me? All right, I'm continuing. So, so there are usually two situations. The first situation is the concept of risk. Risk is usually a situation when the company can identify the probabilities of situation to occur, right? And then there is another concept of uncertainty. Uncertainty actually means that the company is unable to identify the company is unable to identify any probabilities. Any probabilities in the sense that we know that situation A can occur. Situation A, I mean, that can be a poor weather, that weather can be poor, weather can be good, but we don't know what are the chances of weather being good, weather being bad, right? So if we are unable to identify the probabilities of the situation to occur in future, that comes under the heading of uncertainty in terms of decision making. And if we can estimate that situation, that we can identify probabilities of certain event, then that comes under the heading of risk, right? And risk can be solved by using the concept of expected values. Expected values means that, for instance, we are saying that there are 40% chances that petrol prices or fuel prices will increase to $110. And there are 60% chances that fuel prices will remain same at, let's suppose, $90. So what are the chances, what will be the expected value, or what will be the average value for petrol? So I will say that 110 times 40%, this is basically the weighted average of first situation. And then 90 times 60%, that is the weighted average of second situation. So 110 times 40% plus 90 times 60% is 98. So there are 98, the expected value of petrol prices is around 98. So that means that petrol prices will be around $98 on average. This is not the real price, right? But if we are unable to establish these uncertainties, hello? Okay. So, so if you are unable to establish these estimates, then we start with then we cannot calculate the expected value. In that case, we have the other options. And what are the other options? Other option is that we can go for decision rules, right? Now, what do you mean by decision rule? Decision rules means that we have three options. The first option is called maxi-max. The second option is called maxi-min. And the third option is called mini-max regret. So this means what? This means that we have, again, I'm repeating, there are two options, there are two situations. One situation is that future is unpredictable. You cannot predict the situation, but you can estimate some probabilities that what are the chances of the coming event to occur. So if you can estimate the probability, then that will come under the heading of risk. And if you are unable to identify the probabilities, if you are unable to identify a certain percentage that what are the chances of situation A, what are the chances of situation B, and then that comes under the heading of uncertainty. And uncertainty, risk is solved by using expected values, and uncertainty is usually solved by decision rules, right? So we are going to do both situations. We will start with decision rules first, because expected value is something which students can easily understand, and the students have usually an idea what is the expected value. So we will start with the maximax. We will start with decision rules, right? Now, what do you mean by maximax? All right. What do you mean by maximax? What do you mean by maximin? What do you mean by minimax regret? Let me try to give you a basic idea about all these things. See, for instance, let me ask a basic question from you guys. Suppose there are two projects, project A, and there is another project, project B, right? And the situation is that both projects are dependent upon weather conditions, right? And there are, and see, weather can be good, weather can be average, and weather can be bad, right? There are three options now. Weather can be good, weather can be average, weather can be bad, or you can say poor, right? Now, if good if good weather occur, right? If weather is good, then project will A will give you around $500,000 profit, right? These are the profits. And if weather will be average, these profits will be around 300,000. But in case of poor weather, project A will generate a loss equivalent to $200,000. right? Similarly, project B, what is the situation in project B? If good weather will occur, project B is expected to generate a profit of 300,000. If average weather will occur, project B will generate a profit of, let's say, 100,000. And if poor weather will occur, then profitability of project B will be around $40,000. And this is profit. Now, if I ask you as a manager, if I ask you that which option you will select, which option will you try to select? I mean, whether you will select A, whether you will select B, because we don't know what is going to be the weather conditions in the coming period. So usually there are two type of people. One type is basically belongs to someone who is ready to take risk, right? Who has a lot of funds available, who have money available, who have a good background. I mean, his company is good, they have a good cash flow, they have good projects going on. So I mean, if someone is ready to take risk, then he will choose project A. Why? Because project A is generating, let me give you some more distinction. Project A is going to earn 600,000 profit if weather conditions will be good. So the person who is ready to take risk is not considering this poor weather condition, that if this will occur, the same project will result in 200,000 losses. He is not considering this part. He is just considering that, okay, fine, if weather is good, this project A is far better than project B. So I will go with project A. I don't mind if this project generates 200,000 loss. It's completely okay. I can manage that. But the other part, the other thinking is that there are certain people who don't want to take risks, like salaried person. I mean, salaried person are those people who are not ready to start a business, who don't want to take risks, who don't want to invest in a stock exchange. So if your company is going through a bad phase and you are facing cash flow problems, you are facing profitability problems, you are, your condition is not financially stable, so in that case, obviously project A will give you profits, but if something bad happen and weather conditions will be poor, then company will go to further financial crunch. So in that case, managers will be more interested in project B, because though project B is generating low profits, but at least it's not generating losses, right? So it all depends upon the mindset of the person. If the mindset is risk taking, the person will not consider the loss part. He will just consider the profitability part, and he will say that project A is better because project A is generating more profits. I can manage losses, I can survive with losses, so I don't mind if the company has to be a 200,000 loss. It doesn't matter. And if I am risk averse person, I don't want to take risk, then in that case project B will be far better than project A, right? So these are basically two mindsets, right? Your manager can be you as a manager can be any one of them. You can be a risk seeker, you can be risk avoider. Okay, fine. This topic is actually related to risk and uncertainty, because in the last live session we have covered variances, and we did, I think, one question of variances, planning and operational variances we covered. And in this session we have actually started decision making, right? Decision making may we have first started our first topic of risk and uncertainty. And I chose this topic because this topic I will use Excel in this topic. So just give you a basic idea how to use Excel in that. So that's the basic reason. And we have started from the basic idea that what is risk and what is uncertainty, right? So that's basically something which we are doing. This comes under the heading of risk and uncertainty part. All right. So let's resume what I was thinking, what I was talking about. So we were talking about the fact that there can be two types of manager. So if manager is risk seeker, if you are talking about someone who is ready to take risk, and he is choosing project A, then that comes under the heading of Maximax. Maximax. What do you mean by Maximax? Maximax means maximizing the maximum available profits, right? So what are the maximum, acha, what are the maximum profits available? Project A has a maximum profit of 6 lakh. Project B has a maximum profit of 3 lakh. So what we are trying to do, we are trying to maximizing the maximum available profit. So maximum available maximum available profit of project A is 6 lakh. Maximum available profit of project B is 3 lakh. So what we are trying to do, we are trying to maximize the maximum available profit. So we will choose project A. So if someone is risk seeker, he will choose the Maximax rule. Maximax means he will go for the maximum profit, absolute maximum profit. Maximin means what? Maximin means to minimize, to maximize the minimum available profits. Now, what do you mean by this? See, if someone doesn't want to take risk, if someone wants to avoid risk, right, then he will choose maximin. Maximin means what? First, we will consider what are the minimum available profits, right? Project A, the minimum profit of project A is 200,000 loss, and minimum profit of project B is around 40,000 profit. So these are the worst possible options of both the projects, right? And what we are trying to do, we are trying to maximize the minimum available profits. So maximizing of minimum available profit means we will choose option B. I mean, we will see that what are the worst circumstances in all projects, and we will choose that project which is performing best in worst circumstances, right? So Maximax means maximizing the maximum available profit. That is the risk seeker concept. Maximin means maximize the minimum available profit. This is someone who is risk averse. Averse means who is not ready to take risk. Minimax regret is something which we cannot do right now because it's a little bit complicated topic, so we'll do it later, right? So let's start with some calculation, and let's do few calculations in order to understand these concepts, and then we will start with a different question in the Excel sheet, right? I hope this is clear. In case you have any issue, just let me know, and we will cover it later in this question, right? So in the first question, what was, in my example, what was the situation? The situation was very simple, right? The profits of all projects were given, right? But obviously this is not the case. What happened is usually profits of all projects are usually not given. You have to calculate that. So what we are going to do in this question, we are going to first calculate what will be the profits, and then we will we'll apply the concept of maximax, maximin, and minimax regret in this situation, right? So let's start with this question. Let's see what we can do here. It's a very simple and very basic question, right? Suppose that budgeted demand for product X will be 11,500 units if the price is $10, 8,500 units if the price is $12, and 5,000 units if the price is $14, right? There are three options that sales volume can be 11,500, sales volume can be 8,500, and sales volume can be 5,000 depending on the selling prices which we are charging, right? Variable costs are estimated at either $4, $5, or $6 per unit. A decision needs to be made on the price to be charged, right? We have to decide what selling price we need to charge. Now, Before starting this question, let me explain another concept here, because there is one more thing which you guys need to understand, and that is very important concept. See, whenever we solve this type of question, we have to prepare a payoff table. Now, what do you mean by payoff table? It's a very simple concept. There are two variables, right? Usually there are two variables involved. One variable means something which is actually having the uncertainty. It can be weather, it can be ticket, it can be demand side, it can be weather, it can be prices, it can be anything, right? And there is another variable about which we are trying to take a decision, about which we are deciding something. So there is always a controllable variable and there is always an uncontrollable variable. This is not a very technical concept, but try to concentrate here. There is always a controllable variable, there is always an uncontrollable variable. Now let's try to figure out what is the controllable or uncontrollable situation in this case. See, the requirement is saying a decision needs to be made on the price to be charged, right? So we need to take a decision about the selling price. So if examiner is asking you to decide about something, that thing is usually controllable, because it's my discretion. It is completely at my discretion. I can charge selling price of $10. I can charge selling price of $12. I can charge selling price equals to $14. It's completely up to me, right? So anything about which you are going to take decision is usually controllable. And something which is uncertain, something which is at risk, something which is uncertain, that is supposed to be the uncontrollable variable. In this situation, variable costs are estimated at either 4, 5, or 6. We don't know what is going to be the variable cost. It can be 4, it can be 5, or it can be 6, right? We really don't know what will be the inflation. We really don't know how the suppliers are going to react. So this is basically something which is uncertain, right? Now, students usually argue that is it not something which we know already? No. If we know what is a variable cost, we don't need to apply this decision making concept, because we can easily figure out what is the highest contribution at that variable cost, and we can decide about the selling price accordingly, right? So variable cost is something which is uncontrollable. We don't know what is going to be the variable cost. Like in today's scenario, we don't know what is going to be the petrol prices in the coming future. It may increase. I mean, there are high chances that it will increase, but how much, we really don't know. So that is the uncertainty part, right? Now what we have to do, we have to make a payoff table. Now listen, now try to listen, concentrate what I'm saying. We have to make a payoff table by using controllable variable with uncontrollable. UC is uncontrollable. Then we will take the second controllable variable and we will make table with uncontrollable number 1, uncontrollable number 2, and uncontrollable number 3. Right. Now, this is something which obviously students get irritated that what we are doing. See, it's very simple. What is the controllable variable in this case? Controllable variable is selling price, right? So let's start with the selling price. Selling price can be 10, selling price can be 12, selling price can be 14, right? So let's write selling price here. Selling price can be 10, selling price can be 12, and selling price can be 6, right? What we are trying to do, let me remind you what we are trying to do. We are trying to calculate what will be the profits under all circumstances. I mean, profits are not given here, so we are trying to calculate it, right? So selling price can be 10, selling price can be 12, selling price can be not 6, selling price can be $14. right? Now, how you will calculate the profit? We usually deduct variable cost from the selling price first. So what will be the variable cost? Now, variable cost is uncontrollable now. So we will make a combination of selling price with the variable cost. So variable cost can be 4, variable cost can be 5, and variable cost can be 6. So this is basically the combination of controllable with the uncontrollable, right? Similarly, we will take the second selling price. Selling price can be 12 and variable cost can be 4, 5, and 6, right? And then selling price is 14. And with that, variable cost can be 4, can be 5, can be 6, right? So, right. So what will be the contribution in all cases? 10 minus 4 is 6. 10 minus 5 is 5. 10 minus 6 is 4. 12 minus 4 is 8. 12 minus 5 is 7. 12 minus 5, 6 is 6. 14 minus 4 is 10. 9 and 8. So contribution margin per unit can be these figures. And what will be the total contribution? For total contribution, you have to multiply it with the sales volume. So if selling price is 10, sales volume will be 11,500. If selling price is 12, sales volume can be 8,500, this figure. This figure. And if sales volume, selling price is 14, sales volume can be 5,500. Right? That's why I believe that Excel can be very crucial here, because we don't have to calculate all these things. So we will use Excel in the next question, right? 6 multiplied by 11,500 is 69,000. Right? 5 multiplied by 11,500 is 57,500. And 4 multiplied by 11,000 is 11,500 is 46,000. You may also check all these calculations. 8 times 8,500 is 68,000. 7 times 8,500 is 59,500. And then 6 times 8,500 is 51,000. Right. Then 10 multiplied by 55,000. 9 times 5,500 is 49,500. And 8 times 5,500 is 44,000. Right. So we have identified what are the profits, what will be the profit. Actually, this is contribution, but since fixed cost is not given here, so we are calculating till contribution. In case of the availability of fixed cost, we will have subtracted it from contribution in order to calculate the profit, right? So these are the possible outcomes of selling price and variable cost. Now let's just start with the concept of Maximax, right? Let's start the concept of Maximax. Maximax means actually what I'm repeating this. Maximax means to maximize the maximum available profits. So first try to identify what are the maximum available profits. Maximum available profit at selling price of $10. If we choose selling price of $10, then the maximum profit will be 69,000. If we choose selling price of $12, then the maximum profit will be 68,000. And if we choose selling price of $14, maximum selling prices, maximum profit is going to be 55,000. We are not seeing the lower side, we are just seeing the higher side, right? So these are the maximum profit. This is the first part, maximum available profits. Now what we have to do, we have to maximize the maximum available profit. We have to maximize. This is the second step. So what is the maximum available profit? Maximum available profit is at $10. So this, if company choose Maximax, then company will choose the selling price of $12. Right? Simple concept. Now, if we want to apply Maximin, what we are going to do, we have to maximize the minimum available profits. This means what? This means that we will analyze the worst outcomes of each project, and then we will see that which project is going to behave best in the worst circumstances, right? So the first step is to calculate the minimum available profit. This is the first step. So if selling price is $10, minimum profit will be the maximum. Let's write maximum here, minimum here. Minimum profit at selling price of $10 is going to be 46,000. At selling price of 12, this will be 51,000. Okay, please do one thing. Try to mention your number or maybe email address where I can share it. WhatsApp number and email address where I can share these recordings. Or so if selling price is going to be $14, then the minimum profit worst performance is 44,000. So these are the worst performance of all these three projects at all selling prices, right? And since we have to maximize the minimum available profits, therefore maximum profit in all these worst circumstances is this. So the company should, if the company is trying to maximize the minimum available profit, then according to Maximin, company should choose selling price of $12 per unit. Right? I hope there's no question till now. All right. Then there's last situation, which is called Minimax regret. Now, this is something important and you need to concentrate here because this is not that much simple. Now, Minimax regret means what? While doing Minimax regret, you have to redraft your profit. Not exactly. You have to rewrite all the profit outcomes twice. Right. Now try to understand how I'm writing this because you may follow this layout. You may follow any layout at your own, but try to continue with one layout only, right? So what we are going to do, we are going to keep controllable figures here, right? Controllable variables on the x-axis and uncontrollable variable on the y-axis, right? If we are making a table, then we are going to make like this. All right. So let's try to do this again. Controllable variables are what? Controllable variables in this case is selling price because we can control the selling price. We can choose selling price at our own. The selling price can be 12, selling price can be 10, 12, and 14. And what is the uncontrollable variable? Uncontrollable variable in this case is the variable cost, right? Variable cost can be 4, variable cost can be 5, and variable cost can be 6, right? So now what we have to do, we need to, I think my pen is not working. All right. So now what we need to do, we need to plug in all these profit figures here. So if the at selling price of $10 and variable cost 4, at selling price of $10 and variable cost 4, profit was 69,000. Right. And then in the second situation, profit was 57,500 and 46,000. Similarly, it was 68,000, 59,500, 51,000. We are not calculating anything, we are just copy and pasting it here. Right? So this is basically what what we did. We just copied and pasted everything in the table. Now the most important part. We have to calculate the regrets. Now read this the name carefully. What we have to do, we have to minimize the maximum available regrets, right? Maximum available regrets in the sense, I mean, whatever regrets we have to minimize the maximum available regrets, right? So this is basically minimax regret rule actually means. What do you mean by minimax regret rule? Now, first what we have to do, we have to calculate the maximum regret, or first we have to calculate the regrets. Right? I'm repeating, first we have to calculate the regrets. Then we have to calculate the maximum regret, and then we have to calculate minimizing the maximum regret, right? So what are the available regrets? Now, for this, you have to carefully read this table, because this is very important. See, if the selling price, if variable cost is equals to 4, you have to consider the uncontrollable part. At variable cost of 4, I mean, suppose if variable cost is equals to $4, then what is best for the company? If variable cost is $4, then the best for the company would have been selling price of $10, because at $4, the maximum profit can be generated by using $10. Right? So if variable cost 4 occur, then the best option was for the company would have been to choose $10 as a selling price. So if company choose $10 selling price, there will be no regret. Regret will be 0. We will be very happy because we have chosen the best option. But if we have chosen a wrong option, and suppose if someone chooses $12, then we will have a regret of losing or not earning $1,000. Because if we would have selected $10 as a selling price, we could have generated a profit of 69,000. But since we have chosen a selling price of $12, that's why unfortunately we generated $68,000 profit, which is 1,000 less than what it could have been, right? So there will be a regret of $1,000 in this case. 1,000 profit less than the maximum profit which could have been earned, right? Similarly, if we choose this 14,000, if we choose this $14 selling price, then we will earn 55,000, which is around 69, just a second. 69 minus 55 is, which is around 14,000 less than the best option, right? So this means what? This means that the regret is going to be around $14,000. Now, what happened if variable cost is $5? If variable cost is $5, then the best option for company would have been to choose $12 selling price, because $12 will give you highest profit. So if we choose $12 selling price, we will not have any regret. Regret means, I mean, you feel bad that we didn't choose the best option. If we chose a selling price, or if variable cost of 5 occur and we have chosen selling price of $10, then there will be a regret of around, if you take the difference, we will have a regret around $2,000. That the company could have generated 2,000 more if we have chosen the correct option, but unfortunately we have chosen the wrong option. That's why we have a regret. We haven't chosen anything yet. We are just thinking like that if we chose, what are the maximum regrets available at all the options which are given here. Then the maximum regret in this case would have been what? 59,500 minus 49,500, 10,000. So here the regret is going to be around 10,000. And if we choose variable cost of $6, then what is the maximum profit at $6 variable cost? Maximum profit is this one. So at selling price of $12, we would have no regrets. But if we choose $10 selling price, we will have a regret of $5,000. If we choose selling price of $14, then we'll have a regret of 51 minus 44 is $7,000. Right? So we are done with the first part. We have calculated the available regrets. Now what you have to do, you have to maximize you have to calculate the maximum available regrets. So at a selling price of $10, now we have to move like this. We have to see that what is the maximum regret at each decision point. So at selling price of $10, maximum regret. Remember, you don't have to add these figures. You have to calculate the maximum amount. So maximum regret at $10 is 5,000. Maximum regret at $12 is 1,000. And the maximum regret at $14 is 14,000. So these are the maximum regrets which we can face if we choose different selling prices. And now the decision point, we have to minimize the maximum available regret. So what is the minimum regret? At what decision point we will have a minimum regret? We will have a minimum regret at selling price of $12. So according to Minimax decision rule, Minimax regret decision rule, company should select selling price equals to $12. At this, if company chooses selling price equals to $12, then company will face minimum regret. But if it chooses selling price of $14, then it may have to face $14,000 regret. It may have to face $7,000 regret. It may have to face $5,000 regret if it chooses selling price of $10. So this is basically the third decision rule. This is third decision rule was what? Third decision rule was this. Maximax, Minimax, Maximax, and Maximax, Maximin, and Minimax regret. Now, what is the concept of expected value in all these cases? See, if we can identify, suppose that someone says that, look, the problem is that selling price can be 4, selling price can be 5, selling price can be 6. If we are reasonably sure that there are 30% chances that selling price will be around $4. There are 40% chance, yeah, there are 50% chances that selling price will be $5. And there are 20% chances that selling, sorry, no, I'm saying selling, that variable cost will be around $20, $6. So if these are the probabilities which we can attach with the variable cost, then we can calculate the expected value, and then it will come under the heading of risk. Right now, whatever we did comes under the headings of uncertainty. But if we can attach certain probabilities, it will come under the heading of risk. For instance, what will be the case if of $12 selling price? See, its chances is 30%. That means there are 30% chances that 69,000 profit company can generate profit of 69,000. There are 57,500. There are 50% chances that company can generate second profit. And there are approximately 20% chances that the division will generate a profit of 46,000. So if you multiply all figures with its probabilities and add them up, you will get the expected value of first project, right? $69,000 times 0.3 plus 57,500 times 0.5 plus 46,000 times 0.2. 58,650. This is the expected profits at selling price of $12. Same exercise can be done with the $14. Okay, fine. I think we did this. Yeah, so it's not 12, it's 10. Same we will do with 12, same we will do with 14. And then we can calculate that which selling price is resulting in highest profit. Right. So this is something which can be done here. There are 15 minutes, so let me try to calculate. If possible, we can try one question. Let me just a second. Okay, so allow me 2 minutes. I have chosen a different question, but since we just have 10 minutes, so it would be difficult to cover the question which I have selected. So I'm just trying to, just allow me 2 minutes. So let me try to figure out if we can start some easy question here. All right. So we are going to do this question. This is a past paper question of F5, right? Initially, I've chosen this question, but it's really long. So I think it will not be a good idea to do this. So let's start with this question. Let's see if we can, how much we can do it. Cement company is a company specializing in the manufacturing of cement, a product used in the building. Okay, fine. The company has found that when weather conditions are good, the demand for cement increases. demand for cement increases since morning building work is able to take place. Last year, the weather was so good and the demand for the cement was so great that the cement company was unable to meet the demand. The company is now trying to work out the level of cement production, right? What we are going to do, we are going to decide about the level of cement production for the coming year in order to maximize the profit. The company doesn't want to miss out the opportunity to earn large profits by running out of cement again. However, it doesn't want to left with large quantities of the product unsold at the end of the year. And since it deteriorates quickly and it has to be disposed of. So the problem is we don't know what is the demand of the cement in the coming year. So we are trying to manufacture accordingly. So we don't want to manufacture uh, excessive production of cement more than the demand. We don't want to do that. We don't want to build the closing stock. And also we don't want to lose the demand of cement by producing less, right? The company has received the following estimates about the probable weather condition and corresponding demand level for the coming year. Weather can be good. There are 25% chances that weather can be good. And if weather is going to be good, the demand will be 350,000. Weather in case of average weather, probability is 45%. In case of poor weather, probability is around 30%, and company can sell 200,000 bags. Each bag of cement sell for $9 and cost $4 to make. That means around $5 contribution. If cement is unsold at the end of the year, it has to be disposed of at a cost of 0.5 per bag. So this additional cost which company has to bear in case of unsold item, it's not a revenue because they are saying disposal at a cost of 0.5. Right? Usually it's called scrap value or realizable value of losses if in case you are able to sell it to the customer. Cement company has decided to produce at one of three production levels to match one of the three production levels to match forecast demand. It has now been decided which level of cement production to select. Construct a payoff table to show all the possible profit outcomes, that is for 8 marks. And then you have to decide based on Maximax, Maximin, and expected value, right? So all things are in the same question. Don't get confused that how we can do Maximax and expected value both in a single question. We are just trying to solve the question. I mean, practically both cannot be done at the same time. Sorry, I'm taking my words back. There is an issue with the expected value, so we can try decision tables in that case. So I will discuss later that the problems of expected value later in this example. So let's start constructing this table, but before that, let's try to identify the controllable and uncontrollable variables, right? This session may go 5 or 10 minutes beyond the time period. See, we know one thing, that demand is unpredictable. Anything which is connected with the probability is actually the uncertainty, is actually something which you cannot control, right? So that means what? That means demand is uncontrollable, right? Now, how much we want to produce, that is not given here. So in this case, the only option is to assume that company can produce 350,000 units. I mean, company wants to play safe. Company wants to manufacture exactly the same amount of quantity which is in demand, because company doesn't want to produce more, company doesn't want to produce less. So the production can also be 350, 280, and 200. But that we can control, right? So how we are going to make this table? See, it's very simple. We will put production quantity here, right? And demand quantity here, right? So production can be 350,000. Let's start with the lower part. Production can be 200,000. Production can be 280,000. and production can be 350,000. Right? Why we are doing this? Because I don't know if you remember this or not. Let me try to share this screen. Oops, that option is not here. See what we said that we have to make a table which is controllable with the uncontrollable, right? So that means what? That means we are trying to actually construct the same table, right? So this is the controllable part. This is the controllable part, and we are trying to make it with uncontrollable, right? So demand is uncontrollable. Demand can be 200,000, 280,000, and 350,000, right? So these are the possible options combinations of production with demand. And then what is the selling price and variable cost? I think we can take the contribution. It is wrong with the variable cost. The contribution margin for what contribution margin is so total contribution will be what? Okay, we are missing one thing, right? Because there is unsold item. So what we can do is we can we can do here is we can also have uh, column for unsold items. That is so what will be the unsold item here? Production is 200,000, sales is 200,000, production is 200,000, demand is 50,000, gold price is 80,000. The third thing we are going to produce demand is 50,000 all the products. Here, the total of the 50,000 here it will be unsold items is basically the production stage. So if you are producing more than say only you will have right. So what will be the contribution? Okay. Okay, fine. So there's one more thing which is I think we should calculate it now or maybe later. There is something which is cost of unsold item that also needs to be deducted from contribution now. So cost of unsold item. See, if you are doing computer-based examination, if you're performing computer-based examination, then this is the best thing. If you forgot to add a column, you can add it, right? So 80,000 we were unable to sell, multiply by 0.5 because 0.5 is the cost. 150,000 multiplied by 0.5 and then this figure multiplied by 0.5. Rest there will be no cost because there is no unsold item. So total contribution will be what? Total contribution will be $5 multiplied by demand, right? That's going to be around 1 million. Okay. In the second case, we contribution is $5 per unit and we produce 200,000, demand was 280,000, but obviously will not be able to satisfy the demand. So we will be selling 200,000 units. I mean, it's the case that you have, that you were unable to identify how good this film is going to be in the cinema and you book a small theater and the film was a huge success. So in that case, what will happen? You demand is high, but you are unable to satisfy it. So this is basically the same case. Similarly, 5 multiplied by 200,000, it's going to be 1 million, right? Here, the situation is a bit different. $5 is the selling price, is the contribution multiplied by how many units we actually sold? We produced 280,000 units, but we sold only 200,000. So the contribution, oops. Um, sorry. I just tried to do something quickly, but I think it's not possible because there's one issue. Contribution, I mean, we actually manufactured 280,000 units now. We were unable to sell, that's a separate thing. So I think we need to split it. Let's write sales revenue and let's write variable cost. Why I'm doing this, let me tell you. Sales revenue is 9 multiplied by 200,000, right? The first column is going to remain same, right? Variable cost is 4 times 200,000. And this is basically what? This is basically revenue minus variable cost. So in the first 3 column, it will result in the same contribution, but later things will change. Now here, what is the problem, which I just figure out, that revenue will be around, in this case, revenue will be based on 200,000 units because we actually sold 200,000 units. But the problem is we didn't produce 200,000, we actually produced 280,000. So if you apply 5 with the 200,000, we will not be taking into account the cost of 80,000 units. So that was the problem with that $5 contribution. So multiply by 4. This is the variable cost, right? Revenue in this case will be again, selling price is 9, multiply by sales volume is 280,000, right? And how many units we produce? We produce 280,000 multiplied by $4. And in this case, revenue will be 9 multiplied by the sales volume. See, sales volume is 350,000. Sales volume is 350,000, but since we produce only 280,000, that means we will not be able to sell 350,000. So the revenue will be based on sales on the production quantity, right? And how many units we produce? We produce 280,000 units multiplied by 4. So what will be the contribution here? What will be the net contribution? Net contribution will be sales revenue minus variable cost minus these unsold items. All right. Similarly, in the last case, selling price is $9. multiply by, we actually produce 350,000 units, but the demand is only 200,000. So we multiply it with 200,000. Selling price is $9. We produce 350,000, but the demand is 280,000 only. So this will be the revenue. 9 multiplied by, we produced 350,000 and the demand was also 350,000. So we would have sold 3 lakh. We would have generated revenue 3,150,000. Cost will be 4 multiplied by production quantity, which is 350,000 in all cases. Right. So these are the profits. Right. These are the outcomes. If the production is if the production is 280,000. So the second case, the contribution is, and in the third case, now we have to calculate it maximum, maximum, and critical. So what will be maximum? In Maximax, what we will do, we will try to maximize the maximum profits available. So at the production quantity of 200,000 units, 280,000 units, and 350,000 units. What is the maximum profit? Maximum profit at 200,000 is 1 million. Whatever you choose. Maximum profit at 280,000 is 1.4 million, and maximum profit so what is maximum profit? If company wants to maximize the maximum profit, that at maximum we have to minimum profit at all. In the first case, minimum profit is around 1 million. In the second case, minimum profit is 40,000. In the third case, minimum profit is 320,000. So the worst option, worst outcome for the that is project which is performed in all those project is something to and then let's try to do Minimax regret too, because that is something which is so here we will keep all controllable variable and here we will keep all uncontrollable variable. So what are the controllable variables? I'm just removing this. It's very odd. What are the controllable variables? Production. So production can be 200,000. Production. This part is actually the demand part. This is demand. See? At demand of 200,000 and production of 200,000. but we will get. So this is something which we are going to discuss. Um, what is the what is this demand of 200,000 occurs? Then what is which project is giving you the best profit? This is the best outcome. If it is demand level of 200,000, if we produce 200,000, it's fine movie. If we produce 280,000 units, then in that case we will have a regret that we could have created 1 million, but we couldn't. In that case, regret will be more, regret will be 1 million minus. In the third case, it will be 1 million. The second case, maximum profit. We will not have any regret by choosing the second option. The first case regret will be 1400 minus 1 million. Second case it will be 1 million. Third case maximum profit is 175. The first case regret is 1. Case regret is 1. So what is the maximum regret? Maximum regret is, in this case, maximum regret is 10. This case, and since we have to minimize the maximum regret, so minimizing the maximum regret is minimizing the maximum regret means minimum regret is zero. This is minimizing the maximum regret. So in this case, the company should choose product. If we choose the expected value, then if we put some um, demand can be 200,000, the demand can be 250,000, probability can be 0.25, and probability what would be the expected value in this case? We just have to multiply profit. So total of the sum of formula and plus. So what is the maximum value of expected? There is the maximum expected value. So this is what this is like a product quantity. So this is the same result of maximum. Not always the case, but in this decision making is mapping. However, maximum is your opinion? What we should follow? So my answer is you have to analyze how your production, what is your current situation and how your production, how your decision maker behave. If he doesn't want to take risk because already companies in a financial crisis, then go for maximum. If you want to take risk, company has go to maximum. If they take and won't take much risk, then you need to tell you, with the expected value. This question is saying that we can generate a profit of 117. So we cannot generate a profit of 1172. It's a hypothetical figure. We can generate a profit of either 640. I mean, we can generate either profit of 640, 1400, or 1400. Right. So 1172 is not a possibility. For that, I have prepared a separate lecture in my course, so you guys can refer from that. So in today's session, we just covered one more topic and we try to use Excel while doing the calculations. So it's very simple, but I believe that Excel is easier way to do things, because you see, we forgot to add something and we just insert those columns. So if you are doing it manually, then obviously you have to cut the whole table and write the whole table again. So that is a real mess. In C computer based examination, it's something which is easy, right? So that's the end of today's session. I hope you have understood whatever I was teaching. In case of any issue, you can write to me directly at my email address, which is, let me try to share that, zaira.anis.za@gmail.com. Right, you can write any query here, right? And in case you want to join this course, you can contact to IPF institution. They are providing the admissions, I guess, right now. So let me know in case of any query. All right. Thank you for watching this, for attending this class. Take care. Allah Hafiz. Is there any issue? I hope not. Thank you. Take care. Bye-bye.